Hey guys, it is Friday, February 18th, and I am looking at a very red screen today. Wow, I feel like it's interesting because I know there's Russia, always can create some fun conditions for us. And of course, we also have options expiration on the monthlies, which we've talked about, and we have a long weekend because Monday is a market holiday. And so you just have folks that are probably taking a pause, but I actually think this might end up being a pretty phenomenal buying opportunity for certain securities that are just massively undervalued. And the reason I think that is because it is still the case that after listening to 330 something earnings reports, most of the companies are still coming out very, very strong. And I think there's massive differentiation in between who did well and who did poorly. And I think that taking opportunities in this environment to go ahead and pair those off actually makes a lot of sense. So you guys, controversial as it is, I am, as Amazon goes up towards the $3,200 level, I look to try to find exposure on the short side. And then, depending on kind of whether or not it makes sense to go ahead and take some profits on the speed at which it declines back down. I think Amazon is a short right here because, I know some of the activists are in it and interested in it. But I think that unlike an Activision, it's not like you can spin out the core business, but you can't sell it. Do you know what I mean? Like there's no buyer for something that large, right? With Activision, it was only like 60 billion. There's tons of buyers, oddly enough, as crazy as that number is, they can buy it either outright in cash or cash in stock, but there's not a lot of people with $1 trillion extra out there to buy Amazon's core business. And then the other option would be to spin out the cloud business, which means you still have the core business issues that ensue. And I think it'd be really, I mean, in fairness, that probably does need to happen at some point. It's just that right now, if you did it, it would probably be kind of the weakest point with which to do it. So it'll be interesting to see how that plays out. But at least for the next quarter, that thing does not deserve a 50 multiple. Questionably, the data business deserves a 50 multiple because other folks with a data business do not enjoy a 50 multiple. So just keep that in mind as you are listening to the news flow and whatever else might be going on out there. It's a little bit, my issue isn't that I think Amazon is a bad company or that it's going out of business or anything crazy like that. It's just really freaking expensive. It trades at twice the multiple of Google right now, but Google has 0% issues going on with it right now. Just before we came on, this was discussed, so I'm doing this a little bit out of order. All right, let's look at next week. Next week, we do have some great economic data coming out front and center. And part of the reason why it's a little bit risky to be too short or close the day short, aggressively short this market, is because after the long weekend, you have a bunch of economic data that may actually work against you. Do you know what I mean? You've got PMI and consumer confidence. The consumer is very strong. Like all of the preliminary economic data, very strong. With the exception of Amazon, most companies, because of inflation, are actually showing a consumer that's doing okay. Now, you could get, sometimes the confidence index has a piece about like what people are thinking about the future, that sort of thing. So there's that. But largely speaking, people spent and continue to spend. GDP is coming out on Thursday. I think that's going to be, I don't know, we'll see. The only thing that could make this GDP number weak is just because supply chain issues made people buy slightly less, but it won't be because there was a lack of demand. Almost every single company, and I'll show you, is seeing like a demand, if for no other reason than to rebuild inventory. But we're going to go through that because actually there's a lot of misinformation that I think is coming out. And as relates to the inventory build, I just want to show you what I'm seeing. And then you've got at the end of it, disposable income, PCE, core inflation. So it'll be a volatile and wild week, but then we are coming out of, if you get any kind of positive news flow on Russia this weekend, if you've got anything, the market has really compressed its multiples. As much as people want to pretend like it's overstated on multiple right now, I'm going to say that doesn't seem to jibe with what I'm seeing on the actual companies. Now, I do think this is what I'm seeing for earnings next week. This will change because there are still some companies I have to record when they reported their earnings, what have you, because the press releases come out in a very strange way for some of these companies. You'd almost think they don't care if you listen to their investor call, or they just don't believe you do. But this is what I'm seeing. So we've got discretionary starting to come out next week, and I think a lot of those numbers will be very strong. I'm actually going to double down research this weekend to see if there are opportunities in consumer discretionary, because although some of the bigger players are weak, some of the smaller players, especially in apparel, reporting double-digit 20% top-line growth and actually getting margin expansion on top of it, such as Ralph Lauren, such as a couple of the others. Sorry, can't remember the others off the top of my head. You have the rest of energy reporting. This is largely speaking going to be E&P versus the refiners and other folks that pipes, et cetera, that reported. I continue to be very, very positive, because although Russia, some people want to blame the oil price on the conflict that's happening, and some kind of misguided belief that if it resolves, it's somehow going to magically depress the price of oil. That shows that they've literally only been watching oil for a few months, because they missed like the bigger dialogue that's happening in oil and gas. And that has to do with the things that we've been talking about as relates to President Biden here. And this is echoed through every single company that has anything to do whatsoever with oil and gas. And that is simply that, oh, where's it? This, right? This renewable energy rush is making gas, like, this is what we're blaming it on. Okay, Russia, yes, maybe it allows like US, which is a net exporter of LNG, to produce a little bit more and send it overseas, which doesn't necessarily benefit us. But 0% of companies announced that, given the backwardation that is in the oil and nat gas curves, that they're going to just stupidly increase production because the front month is like high. They're going to do what they would always do from a business planning perspective, and that is create the right economics for them to do any kind of additional spend in oil and gas. This also is the other thing that's happening is ESG, which is environmental investing. So a lot of pension funds, a lot of asset managers that want to get their environmental score to be something that's more responsible, they're just really requiring a particular type of economics for the entire complex in order for them to grow supply. And that is just what it is. America, again, a low-cost producer of oil and gas. Here is what we saw in the trading of it. Oil, and this is the February front month, so that's gone already. But we can, I mean, if you look at the subsequent, they all kind of look like this. Spot prices have gone straight up, so you don't have to worry that this graph is so far off. But from here to here, oil companies recovered off the low, but then they continued to fall while oil continued to trail itself upwards. And oil is up almost 80 something plus percent. I think at the time that I took this chart, oil was 92, which is more or less where it's at right now. The companies actually, at the time that I took this chart, they were about 3% higher. So they really have not moved in tandem. And that's just, this dynamic it's not a one quarter dynamic, right? Like, largely speaking, the business portion of the marketplace is still closed. There are still people that are not returning to office. Now, whether that dynamic persists or not is kind of secondary, but even if you have people driving incrementally more, this whole period represents not driving incrementally more. Hey, Richard, always a pleasure to have you join the call. So my call on the E&P names has nothing to do with Russia, because I would have made that call even if Russia was doing absolutely nothing. I think that the volatility of the names doesn't make sense, because even oil and gas is not doing what the securities are doing, and they are reporting. Six more are reporting next week, and you just can't lie about your numbers, is really what it comes down to. Crude oil at one point today was trading below 90. It very quickly made its way back up over 90, possibly because of Russia, but really I think it's because the oil and gas companies are saying, hey, I don't see this situation ending anytime soon. Russia completely separate from all of that. So we continue to love EOG. which has gotten clobbered for no reason in this marketplace. It trades at a huge discount and is the lowest of the low-cost producers within the United States. It should basically print money, and then it's just whether or not they decide to give it back, or if they decide to do more. Um, you know, they'll, if they're like everybody else, they'll give back close to $1 billion worth of money through stock buyback or through dividends, and still do a bunch of capex on top of it to improve their ESG positioning for the future. So I really just think that these day traders, I like to think of them as giving opportunity, right? These when days like today, where given the dynamics, there's a lot of hedging that's going to go on to a 3-day weekend with this much economic uncertainty. You want to just ignore your trading portion of the portfolio and look at the long-term stuff that you would put in your IRA set to a forget sort of thing, because you really do get some opportunities to take long-term capital gains that you would take for a very long period of time. And mostly that's what I'm looking at today, is trying to find those opportunities where they are really cheap. I continue to love Goldman Sachs for that reason, because here at it's trading more or less in line with cash. I just want to show you Goldman Sachs here real quick on valuation. I've been wrong in the short term on this, but ultimately, they basically raised guidance at a conference yesterday, but at the same time, there was an announcement about an ex-banker, ex-employee of theirs that had some kind of corruption in Malaysia. Now, I mean, I don't want to go through the history of Malaysia, because even though, oddly enough, that is something for which I have paid close attention to, given that many of my best friends are Malaysian and I travel there quite often. But essentially, I can tell you at every investment bank, once they discover that there's something like that happens, and you are a former employee, they just box you out, settle, do what they need to do, and it ends up being a very small charge to Goldman. So the fact that it's getting clobbered for that is a buying opportunity. And I want to show you what Goldman trades at relative to book value, because sometimes people think that the best way to value a bank is through earnings, and even there, it's cheap as chips. It's 9 times earnings going into probably what will be one of the strongest investment banking environments of all times. But also, it is currently trading at more or less 1 times book. And I want you to understand something. Whereas for most companies, book value is the net assets that they have. Tangible book value is the net assets that they have, meaning property, plant, and equipment, plus any, and then if you add in intangibles, it's going to be any kind of IP that they have. For a bank, book value is cash. It's cash money. And if it's not cash money, it's cash money with a multiple applied to it to discount for the fact that it's a treasury bond or something else like that. 1 times book means you are paying only more or less for the cash, and you're giving almost no credit to the IP, which is Goldman Sachs, right? Goldman Sachs should not trade at its cash value. It's stupid. And I know some people will be like, well, it can trade lower. Look, banks can only trade lower if there's something that's really an impairment in them. Out of all the banks that would have some kind of massive impairment, you have to really have cojones or be seeing something very specific to believe that Goldman Sachs is the one that somehow is holding the bag. They are never holding the bag. I'm just telling you now, if they're holding the bag, everybody else has a bigger bag. I'm just going to say that, because even during the 2008 crisis, they only took the loan because they were forced to take the loan, and they paid it back first because they had the cash. So this right here is why I'm bullish Goldman Sachs. And at this point, if the market's going to do this crazy set of, I'm just going to short it for no reason, I would just buy it, because ultimately you will get this money back one way or the other, whether it's through a dividend yield or of 2%, which makes no sense on something like Goldman, or whether you finally get this trading at, even a normal discount to Morgan Stanley. Again, they raised guidance at the financials conference the other day, and they traded down because of this Malaysia thing that's going on, which I think will be ultimately a big nothing. It'll get worked out. But I'm sure the news flow will be lots of fun, which is why I think you have to be careful if you're doing it in the options market for the next month or so. If you want to go farther back, that's fine. And we'll look for opportunities on that next week to help for folks that want to do that. The last thing I kind of want to mention is that I know that there's a lot of talk about the idea that GDP and all this stuff is really just inventory build. This is LKQ, and we're going to have in the next couple weeks this amazing guy on the show. I'm really excited. After we leave earnings season, I'm going to start bringing in some really cool people that I think add a lot of value to me, and hopefully will add a lot of value to you guys as well, about their industry knowledge, whether it be old friends of mine in the hedge fund business, or whether it be like, folks that come from industry that I just think are unbelievable resources. I'm going to bring them in. But I wanted to show you, LKQ is actually an auto parts manufacturer, and everybody's talking, oh, inventory build. This whole bit of revenue growth is just inventory build. And my response to that is, no, it's not. Okay, this is LKQ. This is their inventory build, because they just wanted to demonstrate, and other companies as well have demonstrated this, but I like the visual of this one. This is their inventory build. This is 2019. Here's where they're at. They're not back to 2019, okay? So this inventory build argument is, largely speaking, very, very particular to very specific companies. What I think you really do want to do, if you're a fundamental person, or if you're trying to go through the numbers, or you're trying to like do a deep dive, is understand where they started to build the inventory. That's part of the reason I hate Clorox, okay? I hate Clorox because they drew down inventory thinking that at some point chlorine prices were going to go down. Never did. So now they got to build inventory into the highest possible chlorine price that they've got. And guess what? Chlorine ain't going down anytime soon. Why? Because everybody moves south. The pool builds are astronomical. They're definitely fighting with any kind of other company or industrial for that chlorine, because they can, guess what, make whatever they want off of it right now, because the consumer's willing to pay it. So that is, like, I think company by company, that's what I'm seeing in the way of inventory. That's what I'm seeing in the way of margin compression. And I'm looking even deeper and further into some of the names that have reported. What I do is I typically listen to about 400 companies, and then I kind of pause, because then the earnings calendar itself pauses for me, and I start going back over the ones where I need to do a lot more work given what I heard on the call. And I'll be looking at things like this for sure, because this stuff is going to tell me in the second quarter who's going to come out puking the quarter. And so I just want you guys to realize that when you hear these bold comments that are just made across the entire market, they may or may not really be taking everything into consideration that they ought to. With that, also, I'm going to come out again. I know it's going to be controversial. The semis are getting sold today in the weakness that is just generalized market weakness, and we can kind of look at that. There's no, like, I know that the press releases come out, and then everybody's got to write what they write without ever reading any of it, because it's not possible that someone read it and then wrote an article that fast. But what I will say is that these things are cheap. These things are, there's no risk to earnings. There's no risk to margins, because they're just, all of them, passing it right on through. As the CEO of Applied Materials said on his call, my biggest thing is just getting it out the door. And if I can get it out the door, they're happy to pay me whatever it is that it takes to get it out the door. Now, I'm paraphrasing, of course, but you should listen to the call yourself and see if you're not hearing approximately the same thing when you paraphrase what he's saying. When we look at the chart today, like, I would also highlight, of the FANGs, I still like Google the best. I mean, Microsoft posted a great quarter, as did Apple, but I really think that Google's was the cleanest, and it's going to do a 20-for-1 split coming up. We don't know exactly the date, but it is something that the market has thought about. That actually, in my opinion, should help the stock, not hurt the stock, whereas it can be kind of, folks will go all over the map. And the reason is that other folks that have done this were trading at a massive premium, or were trading at multiples that were very high. Google is trading at a multiple right now below its growth rate. That's what makes it slightly different than these two, in fairness to Google. So at its price of almost of $2,600, if you break that up into 20 pieces, you do allow people to take advantage of Google and put it in for the long-term accounts, because right now it's massively undervalued. I'm not even joking. So that one, if you're going to play this, I prefer to short vol on it, which is to find places as low as possible. As low as possible. Don't try to be too clever on this. And short put spreads. So try to get them around 2,500 or below if you can. Do a 5-point, 10-point, whatever it is that you think you can afford down there. If that's what I'm looking to do, is because I kind of don't want to be in this mess of I'm playing around with 2,600 here. I want to be farther back if I'm going to play Google in this environment, just because the market is crazy. Now, do I think it's undervalued as hell at 2,600? Yes, 100%. It is undervalued. It will be here. even if the dinosaurs come back, it'll be and kill us all. New Jurassic Park movie coming out, it will be here. So with that, I'll go ahead and hit the pause button on that, and we'll take questions. What's going on? Hello, any questions?
Hey, yeah, hey man, I think it's really, really important to note that in this really difficult market, you tend to be profitable, and you
Yeah.
seem to hedge, not tradition. I mean, you hedge by shorting overvalued stocks. Like we made a couple hundred points on Amazon. I mean,
Yeah.
and Clorox. I mean, I just think that's really, really cool that you do that.
Yeah, I mean, Clorox is taken is trying to rally here, and I'm not sure who's buying it. So that's why I didn't mention Clorox today. I don't know if we're just getting in the way of buyers. There's really no reason to own Clorox right here unless there's some special thing that someone is doing for a one time situation. I can kind of understand that. Like if someone thinks they're going to spin out and there's just a news flow item that's going to take it higher for like a short blip, um, then maybe. But I cannot find anything on Clorox news flow wise. If you know something, if you're watching this video, just please put it in the comments or ping me if you're a member on the Discord. I would love to know. But at 30 times earnings, given that it's actually guided downwards for next year to demonstrate that it will definitely need a little bit more time to fix the supply chain issues, I just don't understand why it would rally in a red market other than people are either just taking profits off of shorts or alternatively, there's one guy who wants to own it for a very long time. But even then, I just think this is a dumb way to buy it. But I could be wrong on that. Shorting stock is always a really sketchy thing because it just takes one very large player who wants to buy it to and then you have to like sit on your hands for a couple of days or so as it then makes its way back down. PayPal, though, as you know, I've been very bearish on that. Every time it recovers, I usually put on more exposure. Quite frankly, I think that there's no reason for it to not test the $100 level in the next month or so before earnings, because that story is really like he's really got to prove that there's some kind of strategy that makes that company worth more than a market multiple. Um, yeah, it hit a key support level. Oh, thanks. So it's pure technicals for Clorox. Yeah, you know what? I may find like a way to short it again. Let me just see if I want to do a little bit more. Because honestly, there's no. I mean, I think one of the things that really I'm hoping this year investors start to understand, because it does look like people are going to at least attempt to learn fundamentals this year as they go towards value. In theory, that's what I'm hearing on CNBC. In practice, there just aren't enough people that actually talk about fundamentals for anyone ever to really, and it's disappointing sometimes to me, but it's also fun. It creates opportunities, to be fair. Yeah. Um, that's the thing, is that there's like if anyone's playing it today, it's just because it's a low liquidity day, because there's nothing good happening at this company for the next quarter at a minimum. And even if you tried to sell pieces of it, I don't think you could at this multiple. Do you know what I mean? Like, I don't even know who would want to buy the pieces of it. Like cleaning products right now, I don't think that's the main thing people are trying to buy. And I don't even know who the other side of the trade would be on that. And maybe on the beauty, like Burt's Beeswax, they could sell if they in a pinch, but they don't necessarily need cash. They reaffirm the dividend, which is interesting in and of itself. So she's gonna, have to do quite a lot to turn that company around. And at 30 times, I think it should be trading like about half. I saw one report yesterday that tried to say something that I thought was quite foolish. They were like, Clorox is already back to its 2019 levels. So investors, for whatever reason, think it's worth less than it was worth in 2019. And that doesn't make any sense. And I was like, no, it does make sense. Like, have you seen what's happened to all of like her input costs since 2019? And then she's still got less demand that's going to happen, in the next year. Like, no, it 100% makes sense why it should trade down, like below 2019 levels. Like, before 2019, you didn't have this massive exodus to the South, increasing the price of like one of the major inputs to the household products, stuff that Clorox does, which is chlorine. Like, you didn't have this much competition. Now, will chlorine prices eventually go down? Possibly. It is just something that needs to be created in the chemical companies, but quite frankly, you've got labor cost issues across the entire chemical complex that everybody's still trying to resolve. So whether chlorine will make the cut, it's hard to say. Um,
Yeah, we see heavy resistance at 156.
$156. Is that what people are going to try to trade it up to? All right. Like,
No, I
I
mean
mean, I'm
that's
farther back in my puts, but we'll see. I still
okay.
have a few puts remaining. I did take profits, but I have a few puts remaining. But if it tries to dance its way back up to the 50 level, I will try to see. I mean, like if the momentum's just there, it's there. But quite honestly, there's nothing to support this. Nothing fundamentally to support this. You know.
Yeah, I've
So,
got
so
create an alert at 156.
at 156, if it
Yeah,
gets
pretty
there.
right.
Okay,
I
good to
mean,
know.
sure.
I'll
It's a
sit on my
shot.
hands then and find different shorts until then. Yeah, there's no, I mean, like this, I think that in the off season, that is like the period between earnings and actual whatever's going on, there is always a lot of gamesmanship that you have to kind of watch out. So you got to pick your battles very carefully. My battle was Clorox into earnings, that it would puke it out, and it did. So now it's really more about where do I want to reset it. Um, yeah,
Right. I mean, a stock can move up just on short covering, meaning
yeah,
people that were short, have to buy back their stock. I mean,
yeah,
how the market works.
yeah. I think they could. I think they could put the short back on later. Is all I'm saying. I don't be mean to this really wonderful executive that's trying to make it work, but honestly, she's got a really rough environment through 2022. I mean, this is not the staple you want to be in.
Okay. Moving to Fink.
What's that?
He,
Oh,
Mr.
Larry
Fink.
Fink. Yeah.
Yeah. Um, you're saying he does not want to finance green energy, or he does?
He only wants to finance green energy. So part of the reason energy traded down so heavily last year was because, aside from the oil price being at 30, when energy started to recover, people were still like, "Oh, longer term, we're moving off of energy and we're going into EV, and that's how it's going to be." Little did they realize that LNG is really still one of the major ways that the utilities companies, you know, feed the electricity through so that you can have your little EV vehicle. Additionally, from a private equity perspective, ESG is making it difficult to do new projects. More than one company said their cost of doing new projects is higher. So, given that, you know, it's a long-term scenario. Now, a lot of them have proven reserves. There's some of that. If you look at the curve, which I showed yesterday from the CME, if you go 2 years out, oil is at 77. And a lot of these companies are like, well, if oil is at 77 and current spot price is at 92, and I know there's a shortage of oil because OPEC is running at full capacity, I just can't justify hedging myself out at 77 right now until I get a little bit more visibility, because once I pay for the hedge of buying puts, then I've actually recreated the price of oil in the high 60s, which I'm not going to do. Do you know what I'm saying? Like, that was the conversation. It was very, it's so amazing because I think some of the smartest energy traders actually are at energy companies. So I love listening to the call to understand how they're thinking about the curve and how they're thinking about energy prices going forward, what they're seeing. Like, I can't do better research than that. I'm one lady hanging out in New York, so I listen to those very carefully and try to understand what they're doing. Are they putting on collars? Are they doing some kind of funky derivative thing? They're not. They're just like, F it. This is what's happening in oil. I'm going to wait until the back part of the curve comes up even above what it's coming up right now in the 70 level, and then I'll hedge out there. Exxon, they are returning $1 billion, but they actually had in the last quarter hedges on at like the $68 level that they rolled off. So just to give you a sense, I'm not lying, and I'm not whitewashing when I say, like, this is where they're profitable. Hold on, I'll share my screen one more time on that. These companies really are, in the United States, very, 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 very profitable. When oil is over 50, most of them are profitable, but when oil is over 60, they're like super stoked, right? I'm sorry that I'll have to get a different graph that has the actual numbers, but this dotted line is oil at 50, right? We're at 90 right now. It's just money making time for these guys. And they're going to continue to manage CapEx until the back end of the curve comes up, and it has not. So let me try to say it a different way. Like if the back end of the curve was at 80, they would do the appropriate CapEx associated with $80 oil. The back end is not at 80, well over 80. If the back end was at 90, they would do the appropriate CapEx that would justify a $90 cost so that they could make sure that they're not doing wrong by their investors to try to bring in more capacity. That is what is causing the issue right now with bringing capacity on. And there's little that can really be done to change that. Ukraine is a big nothing relative to that. Anything else?
Not for me, thank you.
Cool. All right. If there's nothing else, I will go ahead and end the call. Thank you guys for joining me. Good luck in this crazy market.